everybody. Welcome to today's fundamentals. Hello, Fedros.
Hello.
What's up in the FX market?
Well, the euro is moving in an upward trajectory. The Aussie is moving in a downward trajectory today. And as you know, yesterday's open, the dollar against the yen is moving slightly down, but was up yesterday. So perhaps remaining between yesterday's open and close. The Turkish lira has halted at the 23.65 mark, as we've stated numerous times. Now, the dollar against the Turkish lira halting is anticipation of the CBT's interest rate decision, which is due out today. Now, many market analysts are expecting that the central bank has no option but to hike. Whereas, if you look at recent developments, such as President Erdogan increasing the minimum wage by 34%, one could argue that what's the point of hiking interest rates in order to combat inflation when you're increasing the minimum wage, hence perhaps printing more money and spending even more? So doing the opposite to reduce inflationary pressures in the economy. Hence, maybe the markets are waiting to see some sort of return to normality before moving in either direction. But personally, in the long run, it would feel that the increasing of the minimum wage would counter any interest rate hikes, at least for now. And the British pound is up as we're expecting the bank to hike by either 50 or 25 basis points. So following yesterday's CPI print, which came in higher than expected, market analysts are divided between a 25 basis point hike or a 50 basis point hike. Personally, I would lean towards the 50 basis point hike, as inflationary pressures are still extremely high in the UK economy. And as such, I would anticipate that the bank will hike by 50, perhaps hinting at another 50 basis point hike in the future in order to quickly combat rising inflationary pressures in the UK economy. And the dollar against the CAD is moving in a downward trajectory.
And how has gold's price been reacting?
Well, since the US Treasury yields have been moving slightly up following Fed Chair Powell's hawkish remarks yesterday, it would appear that the inverse relationship between gold and the US Treasury bonds is being highlighted once again. So Fed Chair Powell hinted that the bank is open to 2 more hikes or even more. So hawkish remarks by Fed Chair Powell, therefore US Treasury yields rising, and as such we're seeing outflows from gold and inflows into the US Treasury bonds.
And how about your stock market?
Well, following from Fed Chair Powell's testimony actually before the House yesterday, all 3 US stock markets are moving in a downward trajectory as higher interest rates may be placing a burden on the US economy, hence a reduction in stock prices in the Nasdaq 100, the Dow Jones 30, and the S&P 500.
And what about oil prices?
Well, oil prices are up today. So there appears to be a positive market sentiment surrounding oil, in the sense that it's been said that the US may have to continue oil holdings. So the EIA report, which is due out today, is expected to decrease, yet analysts are anticipating that the US may have to increase their oil reserves, hence reducing supply of oil into the market, hence increasing the price of oil.
And what's in today's calendar?
Well, in today's calendar, we'll highlight Norway's interest rate decision, which is anticipated to be hiked by 25 basis points. Fed Board Governor Waller is due to speak today, and ECB's Panetta. Now, at 2 p.m., we're expecting the UK's interest rate decision, which, as we've said, is a 50-50 chance between a 25 basis point hike or a 50 basis point hike, followed by the Turkish interest rate decision, the US weekly initial jobless claims figure, and we note many Fed policymakers due to speak. So Fed Governor Bowman, Fed Chair Powell is testifying before the Senate, so we're anticipating that his speech yesterday will be simply a copy-paste from the testimony before the House. So nothing too major unless there is an upset, so something that we are not expecting. The Eurozone's preliminary consumer confidence figure for June, the US existing home sales for May, DCB's Vice President de Guindos is also due to speak, EIA weekly crude stock figure, which, as we've said before, and closing off the day is the US Richmond Fed President Barkin. And in tomorrow's Asian session, once again, a busy Asian session, Australia's Eurobank manufacturing PMI figure, the United Kingdom's JFK consumer confidence figure, the Japan's CPI print. Now, Japan's CPI print is interesting. If the CPI print comes in lower than expected, then it validates the BOJ's minutes that were released, where the bank is expecting inflation pressures to ease. However, should the CPI rates come in higher, we may see a more hawkish rhetoric from the bank, hinting at perhaps a sooner rather than later interest rate hike, as we've said before. Yet, it would appear that the JPY might be weakened if the CPI print comes in lower than expected. And closing off the Asian session is the Jaibunk manufacturing PMI preliminary figure for June.
Great. Thank you, Fedor, for your time. And everyone for watching. Join us after a short break for technical analysis.
Hello and welcome to today's technical analysis. So we're going to be starting off with oil. So yesterday we placed resistance at R1 72.30, and as you can see on the 4-hour chart, it bounced, well, it broke above. It validated this as resistance and support, yet after breaking lower, it maintains as a resistance level. So it's at R1. On the 4-hour chart, the RSI indicator is moving towards the figure of 50. So this usually implies a neutral market sentiment, as we've said before. However, our upwards moving trend line is still being validated. It's broken above, it's moving to the mid-range of the Bollinger Bands, and I would expect it to retrace and break higher. So small market correction to the mid-range, garner some momentum, maybe taking up some longs, so some stop losses around here before moving higher. Now, the interesting story is that the Fed is hinting that they're going to hike more, so strangling the economy, one could say. So reducing consumption, reducing investment, etc., reducing economic growth. So one would expect reduction in demand for oil would mean lower prices. However, it appears that there have been some comments made in terms of oil. Hence, perhaps with the US being asked, well, not being asked, being assumed that they should increase their oil reserves, so reducing supply, into the market, as we said in our fundamental analysis. So we're maintaining a bullish outlook for oil as long as it continues to validate our upwards moving trend line and fails to break below S1. Same story for a bullish outlook, breaking above R1 and R2. For a bearish outlook, breaking below S1 and our upwards moving trend line, which would also coincide the breaking below the 70 key psychological level, with the next target for the bears being S2 at 69.40. Euro USD, as you can see, it validated on numerous occasions our support at 1.0910, broke above R1, and is moving towards R2. Now, it hasn't tested R2 yet. It's neared it, but as we can see, there is some selling pressure at this point. So moving lower, I would not be surprised, as we said with oil, maybe a small market correction down to R1 before moving higher. So given that it's broken above resistance at 1.095955, we're switching this to a to support line. So instead of R1, it is now resistance turned support. S1, S2, and S3. So at this point in time, we're going to be looking for a new resistance at R3. So we're keeping S1, S2, S3. R2 will become R1 at 1.1005. So this is our R1. Now, there's a big gap between R1 and R2. So we're going to be looking for a mid-range between R1 and R3, since we're keeping a pretty tight range between our support levels. We're going to be doing the same for our resistance levels. As you can see, I am once again looking for the candles, not for the wicks. The wicks may validate a support or resistance line, in my opinion, yet I'd like to see a body of the candle. So, as you can see, this was a turning point. It broke below, it moved lower. Validated by two bodies here, even though the wick did go up, the price action at the end of the day, the open and close, remained below this level. Validated once again, failed to break above, and then moved lower. Came up, broke above, moved higher, failed to break at R3, moved lower. Validated by another wick, came down, and then we formed our resistance at R1, which is being tested now. So this will become R2, and it's going to be at 1.1050. So 1050. Let's make sure that it's coinciding. Broke below. $10.52. $10.52. I'd like to be slightly more precise. So let's place in our new R2 at 1.1052. R1, R2, R3. S1, S2, S3. Upwards moving trend line. Bullish outlook. Why? It's above 70, implying a very strong bullish market sentiment. Now you might be asking, why am I not drawing an upward trend line from here? Well, this could also be done. Another upward trend line. Yet the consolidation here is, it hints that there is some buy orders being accumulated here as it moved higher. But I'd rather keep my original upwards moving trend line, because I do think that there is some space for a correction. Because if I place my upwards moving trend line from here, yes, it is being validated, and it's reaching the mid range of the Bollinger Band. This is a longer time frame. This is a shorter time frame for me. Yet we can keep this upwards moving trend line. As you can see, it's hitting the bodies of the candles. So it has two upwards moving trend lines. So it's currently testing R1. If it breaks above, move to R2. If it fails to break above R1, it moves back to S1 at 1.0955. Now the pound. On the daily, the pound yesterday moved higher and lower. You can see by the wick. Closed higher. Currently above yesterday's close. So in the 4-hour, these were our support and resistance levels. As you can see, it's breaking above the downwards moving trend line. It's validated as support. And now this is resistance turned support. Yet, given how the price action is on the support line right now, for a bearish outlook to emerge, it would need not only to break below S1, but to move and breaking below S2. So we need to break below S2 for a bearish outlook. Now, we are anticipating the Bank of England's interest rate decision. As we said in our fundamentals, it's a 50-50 chance. Personally, I think it's a 50 basis point hike. Why? Inflation is too high in the UK. Simply too high. Now, one might be saying that might be putting pressure on the economy, but inflation is at 10%. And it's increasing instead of decreasing. So it came at 7.1 instead of 6.8. It's increasing at an increasing rate. Still too high. So how would I personally combat that? I would actually go for a 50 basis point hike, another 50, perhaps even another 25 before remaining on hold. Why? Because I think two 50 basis point hikes and then a 25 basis point hike could do enough to quickly hint that let's reduce our consumption, let's save more, reduce the flow of money into the economy, and bring down inflation. However, if you go more, that might have unintended consequences. So let's place R3, 1.2988. S2 can be removed. Why? Well, we have the interest rate decision today. S2 is simply far too close. So if they stay on the haircut by 25 basis points, easily broken, and even the new resistance is still far too close. So there's simply not enough room for price action to navigate. So I could bring R1 lower or keeping our R2. So 1.2830. So we're just keeping this one is 2.3. Just place in our newer one. So I wouldn't be surprised if it stays between S1 and R1 till the interest rate decision. R2 at 1.2988. And then let's find where we're going to be placing R3. So from a first glance, I'm looking for bodies once again. Bodies of the candles here. Let's just measure the distance. 52 pips. Valid for me. Let's just go back though. Let me show you why. Let me show you why I've placed R3 here. As you can see, 2 points at which price action failed to break above and moved lower. Once and then once again. Validated. Why? Bodies of the candles. The wicks may have gone above, but the open and close was on, if not below this point. As you can see, validated again. Moved higher, failed to break. Slightly more small correction down. Broke below, moved lower. So this is a valid R3, in my opinion. So R3 is at 1.313. 3,135. See? So we're waiting for the interest rate decision. With a 50 basis point hike, I'd expect it to break above R1, if not reaching R2 as well. Moving above 50, bullish market sentiment. USD JPY. We're waiting for Japan CPI print tomorrow. So let's just have a look. R1, R2, R3 are still in play, as is S1, S2, and S3. Look at how it's closing to R1. So they're just waiting for that CPI print to be validated coming in lower. Yes, if it comes in higher than what was expected, breaking below S1, moving towards S2. Currently moving in a sideways fashion until the CPI print due tomorrow. Gold. Same story. It's broken below S1. So this is support turned resistance. We've been switching the same level for the past month, if I'm not mistaken. It's validated again, and again. So this becomes R2. And this becomes R3. So we have R1, R2, R3. I'm going to be keeping the line because it might break back above. And let's find our support at S3. Turning point. So I'm looking at the price action. I want the bodies and I want turning points as well. Prefer using the bodies of the candles, and if there's more touches, then it validates our hypothesis. Breaks below, breaks below. So I have two options. I could either place our S3 here, or I could go higher. Somewhere around here. Too close to S2. So we're going back to the original one, which is at the $1,856 mark. So we become S3. S3 becomes S2, 1,855. And S2 becomes S1. S1. Just fix S3. So let's just have a look at oil. As we've said before, it's actually testing the mid-range of the Bollinger Band as we speak. Finishing off the 4-hour candle here, maybe slightly lower, right around here, and then move higher. Airbus has broken below our support 1 and actually broke below S2. Bearish outlook for Airbus. Just look at how it's a rapid drop in the RSI, breaking below 50, even moving towards 30. And Intel as well, reversing, breaking below S1, S2, and S3. So let's just quickly look at the dollar against the Turkish lira. 23.65. Same story again and again. We're waiting for that interest rate decision. Even if it does move lower, in the long run, I think the dollar will still gain against the Turkish lira. So let's just put quickly resistance, support and resistance lines for Airbus before finishing off for the day. So this is support and resistance. R2 becomes R3. S1 becomes R1. S2 becomes S1. The wick has broken below, but it has not, the body has not broken below support at S1. So S3 becomes S2. And this is my new S3. But rather I'd bring it back here. 120, 50. So we're maintaining actually too much far of a gap, so it needs to be brought slightly higher. 121. So at 121, that's our new S3 for Airbus. We're going to be maintaining a bearish outlook for Airbus. As you can see, it just dropped like a rock, breaking below 50, moving towards 30. Strong bearish market sentiment for Airbus. Can't even draw the downwards moving trend line because it's that steep. broken below our upwards moving trend line, breaking below S1. So for our bearish outlook to continue, it needs to break not below S1 only, but below S2 in order to break below our longer upwards moving trend line. So breaking below S2 would validate the bearish outlook. Yet, breaking below S1 may be temporary towards S2. For a bullish outlook, it needs to break above R1 and the next target being R2. Yet, this drop in the RSI is a bit hard to ignore. So we're maintaining a bearish outlook for Airbus. Just look at this drop. Steep, far too steep. Just look at the price action. Broken lower, immediately tested this one. On the 1 hour chart, it took about 3 hours after breaking below. Then on the 30-minute chart, rebounded off S1 and moves lower. Small market correction. The 30-minute chart, look at how the RSI is below 30. On the 1 hour, it's below 30. On 4 hours, nearing 30. The daily, it's moving, it's at 50. So based on what we're seeing, we're maintaining a bearish outlook for Airbus. And I think that does it for the day. Thank you for watching, and until next time.
In today's session, we will look at platinum as a trading instrument and its appeal to investors. The precious metal has posted significant gains the last few years, especially due to rising demand after COVID-19. However, it is often ignored by investors who turn to gold and silver markets due to the higher volume. Platinum is important for the growth of the hydrogen economy, and demand could expand even further, posing plenty of opportunities for platinum buyers. In the meantime, there are possible trading risks to consider, including a strong USD and falling platinum demand. The pandemic has changed many things and unsettled demand and supply in platinum. While jewelers and car makers were not so interested in the metal as in earlier years, COVID-19 has driven money to precious metals, with many investors turning to platinum. At the same time, its supply was also hurt as lockdowns did not allow for its mining. Platinum is mined in South Africa, in Marikana, with the first platinum nuggets being discovered back in 1924. Anglo Platinum in South Africa is considered to be the world's largest producer of platinum. 7 million and 8 million ounces of platinum are used each year. Platinum plays an important role in renewable energy, especially in electrolysis and in the fuel cells that use it. The hydrogen economy refers the use of hydrogen as a fuel for heat, hydrogen vehicles, energy storage, and transport of energy. The use of hydrogen promises to reduce fossil fuels and limit global warming. Many countries, including the European Union and China, have pledged to reduce carbon emissions by 2050 to 2060 and are invested in hydrogen power. Renewable hydrogen technology generates gas from water and stores it in fuel cells to be used in homes and vehicles. The wider use of hydrogen technology in the near future will require increased quantities of platinum. The limited supply of platinum, coupled with the possibility of hydrogen technology boosting demand for platinum, provide a bullish outlook for the precious metal for the coming years. Investors would be interested to see what will happen to the precious metal and its role in hydrogen economy, but also whether automakers will return to platinum in the future, as the current prices are a strong incentive. This could also push demand for platinum higher. Thank you for watching.
So if you have any questions, feel free to let me know either in the Q&A section or in the chat, and I'll be happy to answer. Okay, so as per usual, before we get started, just a disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. The material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is prohibited. Okay, so I'm Melanie and I will be your speaker for today. Okay, so let's get started. So in order to properly understand or manage a trade, it's first important to understand what a trade consists of. So in this webinar, we'll be introducing the basics of trading, the entry, stop loss, and take profit. We'll then go through break-even and partial profit strategies in our trade management series, but I will briefly go through each of them as well in this webinar because it's pretty important if we're talking about risk management. Okay, so these are the other points that we'll briefly talk about in this webinar, but we'll go more in depth in our trade management series. So we have the break-even, partial profit, idea and validation, trailing stop loss, and diversification. So trade management basically refers to the process of managing open trades in the financial markets to maximize returns and minimize risk. So here are some common trade management strategies for beginners. Of course, we have the stop loss orders, which involves setting a predetermined level at which a trade will be closed if the price moves against the trader. So it helps to limit your potential losses. Take profit orders. Similarly, it just helps to lock in profits. Position sizing. So this strategy involves determining the appropriate number of shares or contracts to trade based on the trader's risk tolerance and your account size. Next, trailing stop loss. So this strategy involves adjusting the stop loss level as the price moves in the trader's favor. So it allows for profits to be protected while giving the trade room to continue moving in the desired direction. Next, we have diversification. So this strategy involves spreading out investments across different assets, markets, and sectors to reduce the overall risk. Okay. So why is it important to have trade management strategies? Firstly, is so that you can control your risk. Trade management strategies such as stop loss orders and position sizing help traders to limit their potential losses and manage their overall risk exposure. Next, we have to maximize profits. Trade management strategies such as your take profit orders and your trailing stop losses help traders to lock in profits and maximize their returns. Manage emotions. So the discipline and structure that trade management provides can help traders to stay calm and rational even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Next, we have to improve trade efficiency. So by having a well-defined trade management plan, traders can make faster, more informed decisions and avoid the cost and time of having to constantly monitor and adjust their positions. Lastly, to increase consistency. So effective trade management helps traders to achieve consistent results over time by reducing the impact of winning trades. Okay. So here is a guideline to managing your trade for risk management purposes. So where exactly you should place your stop loss level or your take profit level. So let's start off with stop loss. So we typically recommend placing your stop loss beyond a major area. So here we're talking about Fibonacci confluence on this slide, but it's basically for any strong levels of resistance or support. So stop loss beyond a key area. So the reason for this is because more often than not, price is attracted to such strong areas of confluence, be it Fibonacci, graphical confluence, or anything like that. And if your stop loss is placed right before instead of beyond the level, it will most likely get you stopped out before the market reverses. So this is one of the reasons why most people wonder why they got stopped out right when the market starts to reverse. Yeah, so then they might start complaining about stop hunting. Now, if we take a look at take profit, we typically would recommend placing your take profit before a major area. So be it confluence area for Fibonacci or graphical or anything like that, we always place it before. So if you take a look here at this little image that I've included here, the take profit will place it under if a Fibonacci confluence is a resistance level. So if it's a resistance, we place it below, okay, or before. Now, if we take a look at stop loss, we will place it under the Fibonacci confluence, since in this case, it's a support level, so we place it underneath. But this is what we mean by beyond it. Okay, so going back to take profit, the reason for placing our take profit before a major area is because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. So instead of reaching your profit target, it reverses back to your entry, or even worse, your stop loss. So this is also one of the reasons why people complain that the market is being manipulated, because they miss their take profit or the take profit by 1 or 2 pips. Okay. So I just want to point out something. If you're a beginner trader and you're looking for a checklist of things to look out for, so something like over here, what we have here, you can take a look at the Forex Army. So that's where we got this image as well. So you go to the forexarmy.com, and there's a whole bunch of guides for you to take a look at, like how to draw a Fibonacci retracement correctly. There's also, I think, a checklist. So it shows you clear market structures, what exactly you should look out for. It goes in depth into Fibonacci, but I'm not going to get into that today. Yeah, so over here, as I mentioned, stop loss, take profit, support and resistance as well, what you can look out for. Yeah, there's just a whole bunch of tools for you to take a look at. So I just wanted to quickly, briefly talk about it in case you are a beginner trader and you're looking for something like this that tells you exactly what you should do or some steps. Okay, now let's get back to the slides. Okay, so this is an example of what a proper stop loss and take profit placement should look like. So this helps you to maximize your wins and minimize your losses. So your stop loss, as we mentioned, should be placed beyond the resistance area, and take profit should be placed before it. So in this previous slide, you can see my Fibonacci confluence where I want to take profit is a resistance area, whereas over here we're showing you it as a support. Just so that you have a really clear idea of exactly what we mean by before and beyond. So I'll just let you guys take a look before we move on. So for stop loss, we will place it beyond. So if a Fibonacci confluence is your support level, we place it under. Now, if your stop loss is a resistance area, we will place it on top of it. Okay, let's go through a couple more examples. So this is an example of a dynamic take profit placement. So we expect price to bounce off our entry at 87.625 at the pullback resistance. So you can see here we have a swing, kind of a swing low over here, right? And we want to use this point as our entry to go towards our take profit over here, right? So since price has surpassed this level, that's why we call it a pullback resistance, because we're expecting price to pull back to this level. Okay, so our entry is considered a in this case, our Fibonacci confluence area, or basically a confluence area. I say Fibonacci because we see over here that we have a 78.6% Fibonacci retracement. So that in combination with the pullback resistance, which is our graphical analysis, that gives us an idea that this level is a pretty significant level, and chances are prices are going to retrace or pull back to this same level. Okay, so that's for our entry. And for our stop loss, we're looking at a swing high resistance here, nothing too special. And take profit is our swing low resistance over here. Now, if we see what happens after that, you can see that price has hit our entry and has reversed nicely off of it, heading towards our take profit. So once again, this is the before. Price hasn't surpassed our entry yet, and this is the after. Okay? Okay. So we're expecting the take profit. Oh yes, over here we have another Fibonacci projection. So this should be projection, not retracement, because we have 3 points here with a 78.6% Fibonacci projection lining up with our take profit. So we're expecting price to hit down towards from our entry towards our take profit. And you can see that, let me just move my image away. Okay, you can see that price just touched our take profit very briefly before reversing off of it. Okay, so this is what we mean by you should place your take profit before a major area. Okay, you can see once price reversed off of our take profit, it went straight towards our stop loss. Okay, so what would have happened if we placed our take profit below? So right at this, or even slightly lower than this point, since we can see that it was just nice, it just touched our take profit. So if we place our take profit any lower, we would not have gotten the any profit, because they would have missed it by a couple of pips and hit it straight towards our stop loss. Okay, so that's why we say place your take profit in front or before the major level. Okay, let's take a look at another example. So in this case, we have a descending trend line, and price recently broke out of this descending trend line, giving us a bullish bias. So we're expecting price to hit up from our hit entry towards our take profit. And you can see my take profit is a major Fibonacci confluence area. Because even though we don't have any graphical analysis, so you can see there's no swing high, no support and resistance, but it's in line with two Fibonacci levels the negative 27.2% Fibonacci expansion, as well as the 127.2% Fibonacci extension. So maybe I'll just briefly let you guys know the expansion basically is a we want to look for a flash symbol. That's how you know that the expansion is present. So we go into in depth into this during our Fibonacci webinars if you guys are interested. But I'll just briefly let you know that there is a flash symbol over here. So we make use of this starting point here, ending point here to determine or to get an idea of where prices are headed towards. Okay, and then for Fibonacci extension, we want to look for a Nike tick. So your Nike tick would be something like this. You can see this V shape here. And you want to make sure that it's at least 100% retraced. So that means the tail is at least the same level as the head of the tick before using this extension. Okay, that was just a brief segue to let you guys know how we got these two levels. Okay. So this is what happened eventually. Just as we expected, prices headed straight towards our take profit. But you can see our take profit, we placed it above the confluence area instead of before the confluence area, we placed it after. And you can see that price reversed off of the confluence area and missed our take profit by a couple of pips. And then it headed straight back towards our entry and our stop loss. Okay, so this is what we mean by placing your take profit before. This is a situation that you really want to avoid. Okay, so you can see here, if we place our take profit before or below, in this case, the major confluence area, price hits our take profit nicely before reversing back down to our entry. Okay. Feel free to let me know in the chat if you guys have any questions. Okay, all good. Let's continue. Okay, so we're just going to briefly touch a bit on break even and idea invalidation. So, because I just feel like this is an important part of risk management. Okay. So break even is a level where you are in profit and recognize that there is a risk of reversal. That's basically the idea for this. Could you have this PowerPoint for future reference? I think this webinar is being recorded, so I'm pretty sure that they would upload this on YouTube, but you can email them for the slides or for the recording. I think just on the IronFX page. No worries. Okay, so now we're talking about break even. So it's basically a level where you are in profit and recognize that there is a risk of reversal. So here we have an entry at the breakout of the multiple swing high resistance level. So let's take a look at this example here. So when I talk about multiple swing high, I'm not talking about this huge swing high here. I'm talking about these two. Okay, so we have these two swing highs. And this is our entry at this blue line. And we're hoping for price to push towards our take profit. Our take profit is over here at this green level. Okay, so now that price has broken out of this swing high resistance, we're expecting it to hit towards our take profit. Okay, so our original stop loss is way over here at this swing low here, and we're placing it beyond, just as we mentioned previously. We want to place your stop loss beyond any support or resistance level. Okay, so but now what happened is that price actually broke, it hit this break-even level. This break-even level is at this swing high here. And it's at this level that we recognize that there's a risk of reversal back towards entry. Why? Because it reversed off of it. And it's at this point that we say, okay, so I think I'm wrong, or I could be right, but if I'm right, price will go all the way to the take profit. But I could be wrong since it reversed, and I should get out of the trade. Okay, so once you've determined that there is a possibility that you are wrong, that's when we move our stop loss line to this level here, which, as you've realized, is our entry. So that's basically what this strategy is about. So we move our stop loss to break even to protect our position. And if price continues to rise, then that's great. But if it reverses, we want to make sure that we are protected. Okay, and you can see right after I moved it over here, it did shoot up a little bit, but then it reversed again and it hit right to our stop loss. Okay, so in this case, why we call it a break even is because it's basically the point at which a trade reaches a level where the trader has neither made a profit nor suffered a loss. So if you didn't place it over here, if you didn't move your stop loss back to our entry, you would have made a significant loss. But now that we place it at our entry, you didn't really make a loss. I mean, you didn't make a profit and you didn't make a loss either. Okay, so this is an important concept in trading because it helps traders to determine the minimum price that they need to sell their trades in order to cover their costs and avoid a loss. So this information can be useful in deciding when to close a trade and take profits or cut losses as well. Okay, let's move on. So now is another concept, idea invalidation. Okay. Feel free to let me know if you're a little bit confused or if you have any questions throughout the webinar. Okay, so let's get started with idea invalidation. So invalidation basically refers to the process of testing the validity of your trading idea. Okay? So after you evaluate whether your trading idea is valid, then you determine if it should be disregarded or acted upon. So essentially, it's a way of determining if a trade idea still holds up in light of new information or market conditions. So here's how the process of idea validation typically works in trading. So the initial idea is that the trader will have an idea about potential trade based on their analysis of market conditions, technical indicators, or other factors. Now then, the next step is to evaluate your idea. By looking at current market conditions and other relevant information such as economic data or your fundamental analysis as well, then you determine if the initial trade idea still holds up. Next is invalidation criteria. So the trader then establishes criteria for invalidating the trade idea, such as a specific price level or market conditions that will cause them to reconsider the trade. Lastly is monitoring. So after you continue to monitor the trade or the market, then you see if the invalidation criteria are met. If the invalidation criteria are met, then you may choose to exit the trade or adjust your position. And on the other hand, if the criteria are not met, then the trader may continue to hold the position or add to it. Okay, so if we take a look at this example here, here it says idea validation is usually placed before your stop loss. So it's the level which you basically admit you are wrong, get me out ASAP. When this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So let's take a look at our entry first. This is similar to our first example. Our entry is at this multiple swing high resistance with 2 swing highs here, and actually 3 over here. Okay, so we're going in for a sell entry because we're hoping price to drop all the way to our target profit over here. So our take profit is here. It's good that we placed it before this major support, multiple swing low support level, right? But then over here, once we see price shot up, it reversed off this level and it shot back up. Okay, it shot up and we're thinking, when price makes this move, we're wondering whether we've made the wrong call. So once price actually leaves our entry or surpasses our entry and heads towards our idea invalidation, once it reverses off of it, we think, okay, maybe we want to get out of this trade. So that's when we modify our take profit and we place it at our entry. So that just in case price reverses all the way down, or rather it reverses and it heads towards our stop loss, we would safely get out of the trade without making too much of a loss. And you can see that's exactly what happened here. Price reversed off of our this swing high resistance, right? And it hit it towards our modified take profit, and it might move down, but it didn't. It reversed off and it hit it towards our stop loss. Okay. Okay, if there's no questions, let's move on. So we just briefly talked a little bit about the risk management techniques that we have and we recommend. Like I mentioned, we go in depth in our trade management series, but I just felt like these were important points since we're talking about risk management in this webinar. So if you're a little bit confused, no worries, we'll talk about it later on in our other webinars. Okay, so now let's get into leverage. So leverage in trading refers to the use of borrowed funds on margin to increase the potential return on investment. So in other words, it allows traders to control a large amount of assets with a relatively small amount of capital. So in the case of Forex, money is usually borrowed from a broker. So Forex trading does offer high leverage in the sense that for an initial margin requirement, a trader can build up and control a huge amount of money. So let's take a look at an example. So let's say you want to buy 1,000 shares of a stock that is trading at $10 per share, but you only have $5,000 in your trading account. So with a leverage ratio of 2 to 1, you can borrow an additional $5,000 from your broker, giving you a total of $10,000 to buy the shares. So this means that if the stock increases by 10%, your return will be $1,000 or 20% of your original investment. Okay, so it's important to note as well that while leverage can amplify profits, it can also magnify losses if the trade goes against you. Additionally, it's important to note that the use of leverage involves borrowing money and incurring interest charges as well as fees, so which can then eat into your profits. So it's crucial to understand the risk involved and use leverage judiciously in your trading strategies. Okay, let's take a look at a couple of examples. So if I have a capital of $10,000, if my leverage is 1 to 20, I would then be controlling a position of 10,000 times 20, which is 200,000. Okay, so if my leverage is 1 to 100, my position would then be $10,000 times 100, which is 1 million. And of course, if my leverage is 1 to 500 and my capital is 10,000, then I will be controlling a position of 5 million. Okay, pretty self-explanatory over here. So here's how we can calculate profit. So if it depends on what kind of an investor you are, but if you are a high-risk investor and your capital is 10,000, your lot size 5 lots, total value of transaction $500,000, and your 100 pip profit would be $5,000, which would then be a 50% gain of your trading capital. Okay, 5 lots in this case means 50, like 1 to 50 leverage, which is why we have 10,000 as our capital. So if your total value of transaction would then be 500,000. Okay. Similarly, low risk, if your lot size is 1 lot, so 1 to 10, your total value of transaction would be 100,000, and then your percentage gain of capital is 10%. Okay, so you can see that with the same number of pips of profit with differing leverages, it gives you very different profits, even with the same beginning, even if you start off with the same capital. Okay, so we've shown you a situation where you make a profit. Let's take a look at if you made a loss. So we call it a double-edged sword because if you made a loss, you would also be making 50% of your initial capital. Whereas if you are low risk, then you've only lost about 10%. So it really depends on what kind of on your risk appetite as a trader. Okay, so let's get into margin. So margin in trading refers to the amount of money that a trader needs to set aside in their trading account in order to open and maintain a leveraged position. So it's essentially a deposit or collateral that the trader is required to put up in order to cover any potential losses. So here we've calculated the margin for you. This is from Investopedia. But if you're wondering how exactly to calculate margin-based leverage, you basically divide the total transaction value by the amount of margin you are required to put up. So that would be margin-based leverage would then be the total value of transaction divided by margin required. So maybe to give you an example, if you are required to deposit 1% of the total transaction value as margin, and you intend to trade one standard lot of dollar franc, for example, that would be equivalent to $100,000 USD. The margin required would be 1,000 USD. So therefore, your margin-based leverage will be 100 to 1, or 100,000 divided by 1,000. Okay, so for a margin requirement of just 0.25%, then the margin-based leverage will be 400 to 1 using the same formula. Okay, maybe I'll just type out the formula in the chat if you were curious. Okay. But most of the time, these margin and margin-based leverages will be calculated for you. But this is just if you are curious. Okay. So let's take a look at the difference between margin for Forex and stocks. So leverage in the Forex markets tends to be significantly larger than the 2-to-1 leverage commonly provided on equities, and even the 15-to-1 leverage that's provided in the futures market. So although 100-to-1 leverage may seem extremely risky, the risk is significantly less when you consider that currency prices usually change by less than 1% during intraday trading. Okay, so in this case, it's up to you as a trader to weigh your pros and cons of trading in the Forex market and in the stock market. Okay, so is there an ideal leverage or margin? The short answer is no, because it determines, it's up to you as a trader to determine whatever level of leverage that makes you the most comfortable, and it also depends on your risk appetite as well. So if you're conservative and don't like taking many risks, or if you're still learning how to trade currencies, then a lower level of leverage, like 5-to-1 or 10-to-1, might be more appropriate. For more seasoned or risk-tolerant traders, they may be more comfortable with 50-to-1 or 100-to-1 and so on and so forth. So although leverage can be pretty intimidating at the start, there's really no need to be afraid of it once you have learned how to manage it. So the only time leverage should never be used is if you take a hands-off approach to your trades. So otherwise, leverage can be used successfully and profitably with proper management. Like any sharp instrument, leverage must be handled carefully. Once you learn to do this, then you have no reason to worry. So small amounts of real leverage applied to each trade affords more breathing room by setting a wider but reasonable stop and avoiding a higher loss of capital. A highly leveraged trade can quickly deplete your trading account if it goes against you, as you will rack up greater losses due to the bigger lot sizes. So that's just something to keep in mind. The leverage is totally flexible and customizable to each trader's needs. Okay, so here let's take a look at the risk. This is from MT4. So the margin denotes the amount held for the trades that are already open. Free margin, denoted in the trading platform, indicates the amount of funds available to open new trades. Next, we have equity. You can see the equity here is 4892.48. So equity, which is your balance plus minus open profit or loss, falls below 90% of the margin required for maintaining your positions. Okay, so this is when you get a margin call. So when the equity falls below 100% of the margin required for maintaining your positions. In which case, you would then need to deposit more cash to sustain your positions or close your account altogether. Okay, and then next we have stop out. So when exactly do you get stopped out? So you get stopped out when free margin falls below 50% of the margin required for maintaining your positions. Positions will be automatically closed by MT4 in order of the largest losing position to the smallest. Okay, and that brings us to the end of our webinar. Feel free to let me know. We still have some time, so feel free to let me know if you have any other questions. I'll be happy to answer them. If not, I will see you guys next week. Thank you guys so much for joining me today. I hope I explained everything clearly. Thanks, Moses. But let me know if you have any questions. If not, you can go ahead and leave the session. Thank you.